Welcome to CoreLogic's July housing market update. The past month has seen a further improvement in housing market activity from both a sales and a listings perspective, but home values have continued to drift lower across most of the capital cities. Nationally, value declines have been mild to date, but the pace of the downturn is accelerating. Following a 0.4% decline in May, our national index fell for a second consecutive month in June, down by 0.7%. Each of the 5 largest capital cities were down over the month, ranging from a drop of 1.1% in Melbourne and Perth to a 0.2% fall in Adelaide. The indices for Hobart, Canberra and Darwin each recorded a subtle rise in values over the month. A variety of factors have helped to protect home values from more significant declines, including persistently low advertised stock levels and a significant level of government stimulus. Additionally, low interest rates and forbearance policies from lenders have helped to keep urgent sales off the marketplace, providing further insulation for housing values. The recent value falls interrupted the pre-COVID upswing that was evident across most of the regions around the country, reflected in high annual growth rates. The 12-month change in home values remains in positive double-digit territory across Sydney at 13.3% and Melbourne at 10.2%. The only capitals where values have declined on an annual basis are Perth and Darwin, but even across these cities the market was early into a recovery phase pre-COVID. Despite dwelling values being down in June, estimates of market activity showed a further improvement from the April low. After a revised 22% surge in sales activity through May, CoreLogic's estimate of home sales in June was up a further 30%. A variety of peripheral housing market indicators have started to look more positive through June. Real estate agent activity is now tracking higher than at the same time last year. We measure activity based on the number of reports being generated across the CoreLogic RP data platform, which has more than 3/4 of Australian real estate agents as subscribers. In the lead up to the Easter long weekend, report volumes sunk by 60%, below where they were the previous year. By the end of June, the amount of reports generated was tracking 5.5% higher than this time last year. This real estate agent activity is highly correlated with new listings activity with a 2-week lead. Subsequently, this rise in real estate agent activity is now flowing through to more fresh real estate listings. The rolling 28-day count of new listings remained lower than it was a year ago, but it was up 42% higher relative to the recent low in early May. While new listings are ramping up, the total listing count has continued to trend lower, indicating a strong rate of absorption. Additionally, auction markets have shown a partial recovery, with the combined capital city clearance rate averaging 60% through May and June. Clearance rates reached a record low of 30.2% through April as a result of the temporary ban on on-site auctions. This saw withdrawal rates peak at 56%, and more than 80% of successful auction sales were negotiated prior to the auction rather than under the hammer. Since late May, as the ban on auctions was lifted, withdrawal rates have normalised, and the large majority of auctions are now selling under the hammer rather than before or after the event. Consumer sentiment readings provide a further signpost for improving housing market activity. After plunging in late March and early April, consumer sentiment readings have rebounded, demonstrating the ability of consumers to make high commitment decisions. Consumer sentiment readings show a very high correlation with housing market activity. Although these readings remain well below the long-run average, improved consumer sentiment helps to explain the rise in listing numbers and a strong rate of absorption via a higher rate of turnover. Perth's long-awaited recovery has been interrupted by COVID-19, with values falling over both May and June to be down 1.4% over the quarter. Prior to COVID, Perth home values had avoided a fall for 6 months straight. Although home values have dropped, housing activity has shown a sharp rise over the past 2 months, with our estimate of sales more than doubling from the low base set in April. Rents have continued to rise through the June quarter as well, up almost 1% to be one of the few capital cities where rents are continuing to rise. So far, the impact from COVID-19 on housing markets has been milder than initially anticipated. Home values are drifting lower, but they're not crashing, and transactional activity has shown a remarkable recovery after plummeting in April. Part of this resilience in values and improved market activity can be attributed to the massive amount of government stimulus and to the mortgage repayment holidays on offer, but other market-driven factors are also at work. A scarcity of advertised supply is one factor helping to insulate home values, with CoreLogic estimating the sales to listing ratio is tracking around 1.3, meaning for every additional new listing being added to the market, there's about 1.3 sales. Another factor is the improving economic environment. Social distancing measures have been relaxed or removed a lot earlier than anticipated, supporting a lift in economic activity. According to the RBA governor, the trajectory of the Australian economy is somewhere between the best case scenario and the central case scenario. A shallower recession and earlier return to growth should see consumer confidence record a further improvement. Despite the early signs of improved economic activity and a lift in housing turnover, the downside risk remains significant. The recent rise of active virus cases in Victoria are a reminder that the potential risk of a second wave remains a stark reality. If we see the virus curve steepening rather than flattening, a return to restrictive policies is highly likely. Another key risk relates to the eventual removal of stimulus measures and borrower repayment holidays. Eventually, banks will be working to ensure customers can repay their loans, and the government will wind back fiscal policies. This is when we could see a rise in mortgage arrears and a potential risk for a lift in urgent or forced sales. The longer-term outlook for the housing market remains largely dependent on how well the economy is tracking when these support measures are removed. The good news is that the economy seems to be on a better than expected trajectory to recovery at the moment. We'll be updating our monthly summary at the same time in August, but in the meantime, you can keep up to date on all the housing market research at www.corelogic.com.au.